Indices saying this morning they haven't told us investors worried that the financial sector is not going to be able to replicate earnings gains for the rest of the year. Here with some market guidance for investors are Tom Lydon, is editor and ETF Trends at ETF Trends, and Roy Williams, CEO and principal Prestige Wealth Management Group, who joins us in our spanking studio. Good to see you both.
Great seeing you, David.
Roy, first to you. What's happened today, first of all?
Well, I think it's a reaction to what's happened with Bank of America and their earnings. People aren't happy. They're reserving more dollars for future losses. But I think, when you look at Bank of America, you look at previous banks that came out with great earnings and great reserving for future losses. You're going to have ups and downs. It's not going to be a one-way street up type of.
Well, Tom, first of all, next time we'll fly you here from Irvine, California. I know Irvine has nothing over York. Actually, we're in rainy York
here.
right
It's
now.
chilly, yeah.
But it is a nice new studio. Let me ask you, though, you have thought that perhaps all the bad news have been priced into this market. You look at what's happening today, I guess not, right?
Well, everyone's looking under the hood. Everybody's waiting for the results of the stress test to come out. And will it really be a valid test, or will it be like the President Physical Fitness Award where every kid gets a
Exactly.
the jury will out, and we'll have to see.
Boy, that's a perfect way to put it. We said it on the curve before, but everybody gets some award, for something they don't deserve.
When you look at the economy is going to take a while to come around. And even the banking sector led us into this and lead us out in a lot of ways. But we do see things improving. We do see home loans applications increasing. We do see real estate inventories working them down.
But does that mean that you buy in stocks right now based on these goodies?
Well, you need to have a long-term asset allocation and make sure that you have a proper proposal based upon your goals. But yeah, you cost average into the market over the next 6 months, because the market will make a fool of you every time. If you look back to the Great Depression, from the bottom to the recovery, it's 9% within 12 months. And even if you get back in, and you're already 25, 30%, you're getting back in.
Tom, we like what's happening.
With all due respect,
okay, go ahead.
With all due respect, I tell you, after 10 years of dollar cost averaging and losing money, investors are tired. They can't take anymore. But if you look at certain areas of the market, there are some areas that are showing some positive momentum. A couple, if you look at China, they've got positive GDP growth. They've surely given off a lot, but they surely look to be in a recovery mode.
But how do you trust their numbers? How do you trust China's numbers in transparency? I have a lot of clients that do business over there. It's very challenging to trust what you see.
So what you do is you just avoid it. If you look at the trends are turning positive. We look at trends, at the simple moving averages, and as long as you stay above the average in the things that you're investing in, you do well. Areas like copper, steel are starting to show some momentum. And technology, all the areas that are the M&A areas right now are all face areas like technology that we saw today.
Tom, let's talk Oracle, since you brought up tech. I mean, this is a very positive development. I see it as a positive development. I mean, that Java wasn't just left to rot. Somebody picked it up after IBM. Is that a start of something new, start of a trend?
Well, we're gonna start to see more of those areas. There's a lot of technology companies out there that have. Again, we know technology is not going away. We're going to continue to move forward in that area, but unfortunately, financials in the U.S. are dragging our overall markets down.
They're driving everything down. Let me ask Roy. By the way, we showed the Oracle. We should have put up the chart for Joe, which is, of course, way up as a result of this. Roy, is when do financials stop dragging the market down? We had thought that would already happen. That if they drag down the market so much, their stocks have been beaten down. To Roy, not to Tom. I want to go to Roy on this question. When does that happen? When is it that finally get financials out of the equation?
I think now when you look at the financials, you're not sure, what the E is going to be going forward, because, with the mark-to-market, with the reserving requirements, and now even the loans are, they're worried about default. But what you see is the consumer is going to start moving forward, and is a few $1 trillion cash, and also.
But by the way, you agree with Tom that you shouldn't trust these stress tests because they're going to grade a curve.
No, because
so you can't go by that as an indicator. Tom, final word, because I know there's some specifics you recommended, and one, steel is of interest to me. Why are you going steel right now?
Well, again, if you look at imports, areas like China in the markets, they're buying more steel. The prices have come down tremendously. And that's a harbinger for what might be coming on the road. I think if we look to areas that may be building, maybe moving positive, where we may not see it here in the U.S., there's some great ETFs that represent base metals, as I mentioned, technology. And also, there's a currency harvest ETF. It's very unique in the fact that it's buying higher yielding currencies with the lowest yielding currencies. Very unique.
All right. Lydon, Roy Williams, we had a little controversy today. Good to see you both. Thanks very much. And Nicole Peddle is down on the floor of the NYSE.